But as promised, let's get in Nikhil Ranka, CIO Equity Alternatives at Nuvama Asset Management, who joins us. Hi, Nikhil. Good afternoon. Good to see you in. It's been a while since we spoke. What's your take on the index? At around 21,700. There was good reason for you to go ahead and buy because risk reward seems favorable. Now we're around that midway market, around the 24,000 odd mark. What do you think? Will it be a slow grind up from here on, or do you think there's a possibility we go ahead and test the recent low?
So, good afternoon, Nigel, and thanks for having me on the show. So the last time we had spoken, Nigel, we were very positive on the markets because the risk reward seemed extremely attractive from those points, and we were expecting a 17-18% upside on Nifty. However, after the 10% move that we have seen from the lows, two things have happened. One, if you look at it, the initial part of the earnings season have actually seen some sort of earnings come cut through. So, especially in the case of IT stocks, if you look at it, there have been 3 to 4% earnings cut on the large cap IT names. And to that extent, therefore, the consensus estimate for FY27 earnings, which was closer to 1330, 1340, is now down to 1310. And therefore, our view is from here on, we probably have a single digit upside on the markets. But then you have to also keep in mind that India could be a big beneficiary of flows in the near term. So when Mr. Trump got elected and came as the president, there was a trend of dollar hardening and a lot of money shifted to US. Now we are seeing the reverse playing out. Dollar index has moved from 109 odd levels to 100 now. And because of this, there can be a trend where money starts to move out of US and get back into emerging markets. And therefore, there is some sort of push and pull between earnings and flows, if you ask me. My base case is that we will consolidate in this band of 23,800 to 24,800 for some time. And then as things pan out, we probably break out on the upside.
So, Nikhil, how would you construct your portfolio now? What are the structural overweights? What are the tactical overweights? What are the sectors that you think will go through a little bit of pain, at least, while we consolidate?
So, good afternoon, Rima. My sense is, Rima, pharma is something that we should look up from these levels. The sector had got derated because there was this tariff issue that was there for the sector. But given the fact that India exports almost 50% of the generic requirements of US, my sense is we should not have significant tariffs that will come on pharma, and valuations still look pretty palatable for for that sector. So that's one sector that we are positive on. In the case of IT, I would say, in the near term, stocks may consolidate a bit. But if you look at and go and analyze the period of COVID, because the uncertainty at that point also was extremely high, we found a very interesting fact that even in that year, the dollar revenues of companies did not degrow or degrew for a very small amount. So, Q1, Q2 for FY21 had declines in revenues. But then as you moved into Q3 and Q4, even though they are seasonally weak furlough quarters, we saw very strong growth in those quarters. My sense is history could repeat this time around. We will have some sort of softness when companies report earnings for Q2 as well. And then Q3, Q4 could start looking a bit strong for IT companies. The point is valuations have come down meaningfully for a large number of IT companies, and on an absolute basis, because there is no balance sheet damage per se in these stocks and sectors, they may not go down much. They may time consolidate for some time, and then we will see sort of up move coming back in these stocks. Tactically, one of the sectors where we feel this quarter could be the bottom of earnings is probably the MFI sectors. The initial commentary from a lot of names also, if you hear, RBL Bank also, if you see, even though numbers were not great, the stock did have a decent move today. Because this quarter looks like the bottom for most of the MFI names, and things should improve substantially as we move in the second half of the year. So that's a tactical overweight for us.
Okay. All right. Got that. Nikhil, just hold on to that thought. We have some very, very important flashes that are coming up for you on the screen. And I think you should keep an eye out there. The DFS secretary has assured that life insurance industry on no action against bank assurance channel. Now, this is a very, very important news flow that's coming in there. And I think the most important stock should be up for you on the screen. SBI Life and HDFC Life, because they had a fair bit of exposure to the bank insurance channel. So both those two should come in there. Yash will join in to give us further details. But as of now, there's, the DFS secretary has assured life insurance industry on no action against them. I think we'll have to wait for Yash to join in. But I think both these two stocks should be on your radar. I think, do we have Yash with us? All right, we'll try to get in, but this should be some kind of relief that's coming in. We'll try to get further details on that front. Nikhil, how are you placed on the insurance companies? Some of these companies have not given any returns. They didn't really participate in the up move, but how are you all placed on them, the insurers?
So we were a bit neutral, Nigel, on that sector, especially given the fact that when, the tax exemptions were taken away for investments amount beyond 5 lakh rupees, there was this concern that the APE growth will slow down for a lot of these companies. And we did see that trend panning out in the last 3-4 quarters where the growth for the sector had slowed down in that sense. But incrementally, I think, if all these concerns start to go away, growth can come back for the sector. And even if we have double-digit APE growth, given the fact that most of these names are trading at less than 2 times price to embedded value, there could be some upside in these names if these overhangs start to go away.
You liked oil marketing companies when we had spoken to you last time. Now, go ahead. And now what is the call on it?
So, Rima, if you actually look at the sector fundamentals from the last time we had spoken, it's actually improved. The last time we had spoken, Brent was closer to $70 to $73. As we speak now, it's closer to $65, $66, and we haven't seen any price cut happening on the petrol and diesel part. So in a sense, gross marketing margins, which were closer to 9-10 rupees the last time we spoke, those have actually now moved closer to 14-15 rupees. There has been 2 rupees of export duty that has come, but notwithstanding that fact, that will go to compensate the LPG losses that these guys are doing. And even if you look at GRMs, they are midway now. They aren't as high as $8-9, which they used to be, but they are still closer to $5. So a combination of these two things, one, GRMs are at decent levels, and second, marketing margins are way above what they used to be, should mean that as we move into the next quarter, because this quarter they will have some inventory losses and therefore reported numbers may not look good. But the next quarter should be very blockbuster for a lot of these companies. And stocks are still trading at closer to 5 times EV/EBITDA on an FY27 basis. So I still feel that there could be 15 to 20% upside more in these names as we go ahead.
Okay, all right. On the back of those, that news flash that's up for you on the screen, which sources are telling our colleague Yash, the stocks that are moving to the high point of the day are, SBI Life, and that's because SBI Life has got close to around 60% of its business from the bank assurance route. So that's the reason why that one has spiked up. HDFC Life, that as well has got around 65% from the bank assurance route. So that's the reason that one has spiked up. We have ICICI Pru, which has close to around 29% of its business from bank assurance. And Max Life, that's the other one in there with more than 50% coming in from the bank assurance route. So that explains why all these stocks are now moving to the high point of the day as we speak. I think Max as well should come up for you. Max, that one has spiked up. Yeah, at the bottom of your screen, you can see all the stocks that are reacting. Well, final question, Nikhil, before we let you go, we're going to be getting Ultratech's numbers in just a while. What I understand was that the con call was earlier scheduled, it's been pushed back by close to an hour or so. But what's your view on cement amidst all these trade tariffs that we're talking about? And if you're looking at a domestic play that's guarded from it, you're going to play the capex revival theme, then cement comes into play. And also the price action for April has been fairly encouraging. Your view on cement?
So structurally, if you look at the sector, Nigel, the good thing that is happening is it's getting consolidated into 2-3 players. So we now have Ultratech with close to 200 million ton capacity. We have the Adani Group with another 150 million ton capacity. And then we have the likes of Shree, JK Cement. So my sense is, next 3-6 months, stocks can still consolidate. But if you ask me 12-15 down the lines, we are more seeing a telecom-like scenario in this sector where the pricing power will be extremely strong in the hands of the top 2-3 guys. And then, my sense is 1,000 rupees of EBITDA per ton becomes the floor for a lot of these companies. And we are potentially then looking at companies starting to do 1,300 to 1,400 rupees of EBITDA per ton on a sustained basis. And once that sort of volatility goes out in terms of the profitability and we have more steadier EBITDA per ton getting reported from these companies, the EV EBITDA multiples for these companies should start to re-rate. So with a 12 to 24 month outlook, I think the sector holds a lot of promise and any weakness in the sector should be looked to be bought into.
Got it. Okay, all right, Nikhil, we appreciate you joining in, and we take note of the fact that last time around you were sounding reasonably optimistic on the markets, and it worked in that favor as well. Look forward to chatting up with you rather soon. For the time being, let's slip into a short break. As we do that, well, here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV 18, the all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates. All of this at your fingertips. Just download the CNBC TV 18 app now from the Apple Store or the Google Play Store, or you can simply scan the QR code that's up for you on the screen.